Very good morning. I am Sandeep Chawda from Malaviya National Institute of Technology, Jaipur. I am research scholar. Today I am going to present my paper on impact of renewable energy availability on load serving entities, sale price and procurement decisions. So I'll start with introduction. As we know that deregulation and restructuring has changed the way of operation of power system, and it has introduced electricity market and several new entities. So basically, the electricity market is divided into two segments. One is wholesale segment, or we can say wholesale electricity market, where generating company and reseller, which is basically electrical utility company, or we can say a load serving entity or retailer, that take a part. And the other segment is retail segment, where this load serving entity or reseller that and consumer take part. So basically it is called second stage of trading. So my focus is on the retail segment, that is the load serving entity. So basically, I'll talk about load serving entities decision making. Ultimate aim of load serving entity is to maximize its profit. So this profit can be defined as it is revenue minus cost. So basically, it aims to minimize this procurement cost and interested to maximize revenue. So this cost can be minimized by taking optimal procurement decisions. So as it take parts in wholesale electricity market, so the quantum to procure from this market has to determine. In addition to this wholesale electricity market, it can use bilateral contracts or forward contracts, and in case if they have self-generation facility, so they can use this. So they can minimize this cost by optimally procuring from these sources. So for this decision, it requires the consumer demand and definitely information about wholesale electricity market prices. The other side is that revenue maximization. Definitely the load serving entity has opportunity to determine its prices, set the prices which is offered to the consumer, and consumer generally respond it by changing its demand. So depending upon its sensitivity to prices, it basically respond to the prices, offered prices, and it revise its demand. As I said that load serving entity mainly procures from wholesale electricity market, so it is very well known that the prices in wholesale electricity markets are volatile, and it is an investigation shows that it is more than 400% than any other commodity. So due to this, the risk is posed to substantial risk is posed to load serving entity, and that's why it has another objective of risk minimization. So ultimately the load serving entity has two objectives. One is the profit maximization and another one is the risk minimization. As already I said that on procurement side it has several options it uses, that is wholesale electricity market, bilateral contract. Bilateral contract are basically the fixed price and fixed power contracts. The self generation, it can use thermal generating units, it can use renewable based self generating unit. The uncertainty already I discussed, that is the wholesale electricity market uncertainty. As if it considered RE, then the renewable uncertainty is also another concern for load serving entity. There is one more uncertainty which is associated with demand. Of course, the demand is varying over the time, so it has to LSE has to take care about that. Basically, in my work, I have considered it as a variation, considered as a demand variation, and in sales side, as it has to determine the prices, so it can offer prices under fixed pricing scheme, where the prices are usually kept fixed over a period of time. There is a disadvantage in this scheme, that is that it do not reflect actual wholesale electricity prices. It cannot reflect. So average is generally offered. The advantage is to consumer that they are not exposed to wholesale price uncertainty or the volatility. And dynamic pricing scheme, or we can say the time varying pricing scheme, where the prices are vary over the time. And it has advantage because it can significantly reflect actual wholesale prices. And as part of risk is exposure is there to consumer. Actually, consumer has to bear certain risk of wholesale price volatility or uncertainty. Example is the time of use prices and real-time pricing. So depending upon the variant of dynamic prices, the risks are posed to the consumer. So here is the problem what I am going to consider present here, that is LSE's decision-making problem, and the renewable is considered majorly here. Impact of renewable availability is analyzes. So two types of decisions are determined, that is optimal procurement decision and the dynamic prices. For procurement sources, I have considered wholesale electricity market, bilateral contract, thermal generation, as well as renewable generation is considered, solar is considered, and wind is also considered here. And the consumer behavior, that is considered through its price elasticity and uncertainty. I have considered the wholesale price uncertainty, and for that mean variance criteria is used. And the RE, for handling RE uncertainty, it is considered in aggregated form, so it reduces its impact on LSE's decision making. Here is the mathematical model. The first equation is showing the objective function. As I said, it has multiple objective, that is the profit maximization and the risk minimization. So the first term is showing the profit, the next term is showing the risk. Here the profit, that is revenue minus cost, that is given by equation number 2, and cost is definitely the cost from procurement of from various sources, that is the bilateral contract, self-generation, and the wholesale electricity market prices. See, in self-generation, I have considered the cost of renewable also, and the revenue, that is given by the demand multiplied by the prices which are offered. So basically here this D actual is the demand which is determined after the prices are offered, basically the revised demand. So for that, this relationship is used here, that is the demand function I have used, which is showing the relationship between the demand and the sale prices. Here the DT is the, here DT is the actual initial demand, and D actual is the revised demand, and this one is the nominal sale prices, and lambda T cell is the prices to be determined. And this epsilon T is showing the elasticity, that is the sensitivity of consumer that is considered. And the second part, which is the risk here, that is, as I said, I have used the variance or mean variance criteria. So it is calculated statistically using this equation. This is the variance of the spot wholesale electricity market prices. And here this term is very important, that is the beta, which is showing the risk averseness of LSE. Risk averseness means retailer is not interested to take or bear more risk. So this beta defines the behavior of load serving entity. If suppose beta is equal to 0, in that case we called the load serving entity is a risk neutral, has risk neutral behavior. It means it is not worried about risk. But as beta's value increases, its risk averseness increases, means it don't want to take more risk. And the last equation here presented, that is showing that the total initial demand and the revised demand, that will remain same. So this way the demand shifting is modeling. As my aim is to determine the dynamic prices, and interested to determine price in such a way so that the maximum profit can be earned by LSE. That this objective function 1 is maximize subject to the procurement constraints and other constraints, definitely the bilateral contract constraints is there, minimum and maximum limits are posed on there. Then there is wholesale electricity market. I have considered that LSC cannot sell into market. If it has some excess supply, then it cannot sell it, because interest is here to determine the dynamic prices. And the thermal generating unit constraints are considered here. That is the startup, shutdown, cost limits, ramping down, ramping up, ramping down, minimum uptime, minimum downtime, minimum and maximum generation limit. Then on sale prices, I impose upper bound and lower bound. This is required that because lower limit is required, because if there is not a lower limit, then might be it can lose revenue. It may incur losses. Prices can be set to lower value. And upper bound is required because it can set any value. So it would be not good from consumer point of view. And the energy balance constraint is used here because LSC is obligated to supply the consumer demand. It means that at every instant, the procurement and the supply should match. So already I said, focus of the work is renewable generation, to see how prices are varying with PV, solar, and wind. And because in this work I have considered the cost, and the consideration of cost of RE is important. If suppose I am not considering the cost of RE, so it is considered as generally it is freely available energy from RE sources. So at that time the prices would go down. So to reduce that impact, the cost of RE is considered, and RE uncertainty is considered in the aggregated form. So here is a case study. I have considered the PGM market. The data is historical prices are taken from PGM market. Planning period is considered of 24 hours, that is 1 day. One bilateral contract is considered for 24 hours, which is having price of $34 per megawatt hour. Minimum maximum procurement is 30 and 350 megawatt. A thermal self-generating unit is considered, that is of 130 megawatt, and the consumer elasticity is considered equal to minus 0.4. RE price is considered here $28 per megawatt hour, and the flat rate, the nominal sale price, that is considered equal to $35 per megawatt hour. This is calculated by taking average of wholesale electricity market prices, and the minimum and maximum bound on sale prices is considered, that price can vary up to 18% of flat demand. So these cases are considered here, that PV is considered for case 1, case 2, case 3, case 4 wind is considered, and for case 5 and case 6 I have considered both. So here is the considered profile. The red one is showing the PV case, the green one is showing the combined profile, the profile for wind, and the black one is showing the profile for both. And this one is the demand. What I have considered, this is the wholesale electricity prices, this red one, and this one is the variance which is calculated. We can see that there are 3 peaks, 1, 2, and 3. So this is showing that here the risk is more, that variance is more, so risk is more. So a risk averse LSE want to minimize risk at these instants especially. So here is the result for the PV case, and I have considered both cases, that is the risk neutral and risk averse behavior of LSC. So the red one, this one is showing the penetration is considered here, the 10% of the PV. So based on that, this is the obtained sale price profile, and the solid line is showing the nominal sale prices. So we can see that the prices, this price is actually following the wholesale electricity market prices, the pattern of that prices. And the prices are offer high when the demand, this solid line is showing the demand, so demand is high. So LSE is interested to reduce demand at these hours, so the prices are kept high for risk neutral case. So we can see that the demand is reduced in this hour, and where the prices are low, the demand is increased. And this one is the risk averse behavior, because it don't want to be a risk. As I pointed out that at certain moment the risk is high, so it is offering higher prices to these hours, and here again the risk was high, so the prices are high here. At this point also there is comparatively risk is high to other hours, that's why again the prices are high, and corresponding changes in demand can be noted in this figure. And this is as we are increasing the penetration, or 20% of PVs increase. So in that case, there is to accommodate the increased value of PV or solar, it is changing its profile. So it is decreasing basically price at that moment, and corresponding changes we can observe in this demand. Revised demand. Here is the case with wind profile. In wind profile, as the power is not concentrated, the power is available throughout 24 hours. So we can, it is also following the wholesale electricity market prices, but we cannot see the significant changes because the penetration is very less. However, we are increasing penetration, little bit changes we can observe in the sell prices. The other things remain same. The behavior of that is risk neutral and risk averse behavior. So we can see corresponding revised demand in this figure. Then when we are adding both, we are considering both PV and wind sources. At that time, we can see there is a variation in the prices for both risk neutral LSC and the risk averse LSC. We can see different ups and down in the sell prices, and this is due to only the availability of wind. One interesting point, we can see that here there is a prices are reduced too much. This is because there is too much, there is the quantum of PV and the RE availability is more. And for considered case, it cannot accommodate complete RE. In this case, the 20% of PV and 20% of wind are considered, but this can accommodate only 18%. So there is some curtailment in RE. So it cannot accommodate basically. So anyway, this is the not useful RE for this one. So LSE usually try to accommodate complete RE. That's why it is decreasing the price. But as there is lower bound, so it cannot further reduce price. And this is the place. This is the hour where it can increase maximum demand, because it is limited by the sensitivity or the elasticity of consumer. And this is the result for procurement, and we can see that this is basically showing that as risk averse LSE what it is doing. We can see that the risk averse, as risk averseness increases, LSE don't want to bear more risk. It starts decreasing procurement from wholesale electricity market. It starts increasing procurement from the fixed price sources, that is the bilateral contract. And definitely the PV is limited, so it cannot change its value. So PV is constant, and it starts increasing the thermal generation. It is happening in all the cases, and here it is the efficient frontier. On the basis of this, LSE can take decision. Basically, it is a graph between expected profit and the risk. So these are obtained for all the cases, and we can observe that if LSE want to bear less risk, at that time the expected profit would be less. And here is the conclusion that particularly this work is for LSE's decision making, and both optimal procurement and sell price decisions are determined, and impact of RE availability is analyzed. It is observed that as RE is available during that hour, LSE try to reduce its prices to maximize its profit. Here is the references I have used. Thank you. Thank you very much.